When I'm sitting down with first-time home buyers, the main discussion ends up being if you should buy and if you should rent. And if you've already watched my last video up in the corner here, you are gonna have a decision on your hands that is extremely difficult. But once you've made that decision, and if you've chosen to buy a property, there's some things that you may not be prepared for that I am going to prepare you for today. My name is Mike Carpino. If you're interested in getting some assistance in the real estate market, don't hesitate. Click that first link in the description box down below. We can have a 30-minute consultation call for us to find out together if we are the right fit to figure out what your path is in the real estate game. So today I've got 4 scenarios for you. We are going to use the hypothetical situation that you are purchasing a home for $500,000 and you are putting down the bare minimum 5%. So if you've already made it to this point in your home journey, you're gonna be aware that there are some additional fees. So you're gonna have to pay for insurance on your mortgage, which is built into this. So the remaining mortgage payment at the end of the day on a $500,000 purchase is $494,000. Each scenario is gonna have the same mortgage balance of $494,000, but what we're gonna do today is really show you how you can maximize the amount that you are paying off your mortgage, what options might be best for you. If you're buying in today's mortgage climate, we are going to show you what a variable rate today would be and what those payments might be like. And if you are buying with a fixed rate, we will also break down what that payment looks like. So scenario number 1 that we are going to cover here is if you had a $494,000 remaining mortgage, you had a variable rate at 6.95%, you chose to go with the 25-year amortization, and we were just gonna make monthly payments on this mortgage. Now you're gonna see from the chart that we have here that as the mortgage term progresses, you're gonna pay off more and more principal each year. And what that's gonna look like on this schedule down below here, just in your first 5 years, if you just did this 5-year term at a variable rate and it doesn't change, you'd be paying $206,000. That would be broken down into 2 segments, your principal and your interest. The principal amount you're paying off is about $44,000 and the interest paid is $162,000. I know this doesn't sound like you're paying off a lot, but this is the way the mortgages work. They are front loaded with interest, so as time moves on, you're gonna pay off more and more as that chart does show. So the next scenario I'm gonna show you is if you chose to go variable, 25-year term, but you did accelerated biweekly payments. So take a look at this chart here. Look at how much quicker you start to pay off more principal and balance that out with the interest. It's gonna be about 5 years quicker that you get to that principal and interest 50-50, but more importantly, look at the 5-year difference. So in 5 years, if you do the accelerated biweekly payment, so you're doing a payment every 2 weeks instead of once a month, you're gonna pay $223,000. But check out the distribution here. $65,000 is gonna come off the principal amount, and the interest side of things is $158,000. Amazing, $20,000+ on top of what that other option would have been for you. So if you are getting your first mortgage, check out the quick hack we have here. Make your payments every 2 weeks. It'll give you ultimately 2 additional payments a year. And look how much extra you are gonna take off the principal of your home. $20,000 additionally just in the first year alone. Pretty amazing if you think about it. All you're doing is making a couple extra payments a year and you're paying a significant amount more of that principal. So this here is the fixed rate scenario. So we are basing this off of, once again, a $494,000 mortgage. This time we're gonna go with a fixed rate for 5 years at 5.5%. And then, as you can see on the chart here, you are gonna have this very similar trajectory that you saw when it came to the variable rate at 6.95% and the same amortization on the monthly payments. So without doing the accelerated payments, you saw a very similar looking chart. Now let's look at the numbers, what you're gonna be paying off in your first 5 years. So because you're fixed at a 5.5% rate, you're gonna pay off more. You're gonna have more principal that is paid off. So in this scenario, you've paid $180,000. That's divvied up. You have $53,000 that is paid off on the principal side, and the interest side is $127,000. So right off the bat, obviously it's gonna be cheaper if you went the fixed route versus the variable route in today's specific climate. We don't know what that looks like over the 5-year trajectory. It's possible that the variable rates do come lower, but let's just say you locked in at a fixed rate and the variable did not change. Now let's take a look if you had this fixed rate and you decided to do the accelerated bi-weekly payments. Now, as you can see, that chart looks so much better, and it looks even better than the variable rate accelerated bi-weekly. Obviously, with the lower interest rate, it's gonna look better. Now, I want you to see the big difference. Now, let's keep in mind, when we did this quick adjustment on the variable rate, we paid off $64,000 of the actual principal in the first 5 years. Now, let's take a look at how much principal we're paying off in the first 5 years if we went with the fixed rate at 5.5%. There you go. So principal, we have now paid off $70,000 principal in the first 5 years out of $195,000 total payments in the first 5 years on our mortgage. And then that leaves us with $125,000 paid in interest. So we've got $70,000 and $125,000. Now, remember what that looked like if we just did the monthly payment? That was $50,000 and $140,000. One of the biggest things that people don't understand when they're getting into their first property is how much your payment frequency can actually affect your mortgage payment, how much interest and principal you're actually paying. In this scenario, we've seen how much of an advantage there actually is to changing your payment structure to accelerated bi-weekly, no matter what avenue you're in. So if you have a variable rate or a fixed rate, you should be immediately switching to the accelerated bi-weekly option. No matter who your mortgage provider is, you should be allowed at least a one-time option to switch your payment frequency. It may squeeze your bank account just a little bit more, but when you're looking at the ultimate savings here at the end of the day and the amount of equity that you are building in your property, it makes too much sense for you not to take advantage of it. The bank, however, may encourage you to do monthly payments and continue keeping things the same, understanding that they are going to benefit more when you pay more interest at the end of the day. As a homeowner, the ultimate goal is to pay your home off as quickly as possible. When rates are higher, that's even more important. Now we're saying higher for today's standards. So if we're in the 6% range, that's higher for today's standards. We are not going to end up back at 1 to 2%, but ultimately we may end up living in that 3.5% to 5% range. In today's climate, if you are getting a mortgage, start with your accelerated bi-weekly. It is going to be an advantage that you can really use early on to pay off more of that principal. And if you need to move in 3 or 4 years, you've actually paid off more of your principal, which means you have more equity in the property, so you have more invested in your property and you haven't just thrown it away in interest. I hope this tip has been helpful for you. If it has, don't forget to subscribe to the channel. If you want to talk one-on-one about what is next for you in the real estate market, hit the first link in the description and we can have a one-on-one consultation call. My name is Mike Carpino and I will see you in the next video. Bye for now.